I think it's going to be different this time, though. I think the outcome, instead of a top and then a bear market in gold, I think the world is facing a monetary crisis, economic crisis, a political crisis, all things coming together.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for your time today.
Good to be back.
Well, it's great to have you. We've seen obviously a very exciting few months in the metals. We had you on last month and definitely, talked about the rise we've seen. We've continued to see a rise in both gold and silver. Silver finally catching up now, and we've seen a slight, consolidation, not a huge pullback or anything like that. In your recent report, you talked about how a lot of people are expecting a significant pullback in the metals, but if you look at history and what we saw, for example, in the 2008 pullback in metals, we've really already seen that pullback. And now it seems like we might be off to the races from here, your perspective on where we are.
That was a point I made in the weekend report. What I did is I showed a monthly price chart of gold during the last bull market from 2001 to 2011. And it was a laborious 8-year process up through about 2008. Where you'd go up, nice advance, and then you'd spend a year or more going sideways with dips, just bore the heck out of you. And finally, in that October 2008 sell-off in gold, which was sympathetic with the stock market crash. By crash, what I mean is something that takes 30% off of a market in a matter of 2 weeks. Okay, that's what happened in 29, happened in 87, and in October of 2008, the S&P was already a year off of its high, had been declining for a full year, while gold had been going up, by the way, during that time. And during that, basically late August, early September, and especially October of 2008, there was this crash type event in the S&P. And sure enough, gold had a sympathetic drop, though it had been opposite the S&P for the prior year. But anyway, it did have a sympathetic drop. And it was one, when you look at the price chart of gold back then, there had been a range. It hit 1,000, backed off, hit 1,000. These are all-time new highs now. And it was July of 2008, before that drop, you hit 1,000 for a second time. And then that pullback finally sold off enough to where on a price chart, you finally took out a prior prominent low. First time in years that gold had a sell-off that actually took out a prior low. So in effect, it had a cleansing drop. As soon as it finished that drop, boom, back to the highs. Okay. Meanwhile, S&P continued down until 2009. Very similar thing happened between 2020, 2022. You come up to 2070 price level, backed off, came back up to 2070 again in March of 2022. So you, again, back up to the high for the second time. And it was the pullback from that March 2022 high that finally got out of control in when? September, October of 2022. And you took out a bunch of prior lows, just like what happened, like you said, in 2008. As soon as you did that, boom, you're back to the highs. So it was a fake out. That was a cleansing drop that was similar to the 2008 debacle. It was over with so fast, if you were on a long vacation, you missed it. Okay. Everybody seems to think we have to have another one. Why? You just had one. Okay. I don't think the stock market is about to crash, by the way. I think the stock market, if it's going to crash, which I think is a possibility in this bear market, doesn't always occur in bear markets, stock market doesn't always have a crash. .com bubble never had a crash. Okay. It's going to take some months of downside arm wrestling in the stock market before you finally get it to levels that could generate a sharp, rapid sell-off. Between now and then, I'm suspecting you got several months of arm wrestling decline. Now, there's some levels below the market, but they're down there. You're not threatening them right now. So I don't think there's any near-term jeopardy next couple months of anything like a crash in the stock market. Now, you get a little closer to the election, yeah, maybe. So gold, I don't think is threatened by that phenomenon again. And between now and the next couple of months, I strongly suspect gold's going a lot higher, and silver and miners especially a lot higher. And as you noted, if you go back to the February low of this year, look at the gain that silver's had from that low to the current price, even though there's been a recent pullback. Look at the percent gain in the miners from the February low to where they are now, and look at the percent gain in gold, and you'll find gold is much less gain on a percent basis than those two subcategories. So anyway, I'm not worried about a sharp sell-off in gold. Yes, you're going to have week-to-week drops here and there, but I think we're in the acceleration phase, meaning that part of the bull market where most of the bull market gains of the entire trend at 8-9 years, in this case, we're 8 years old as well, will be compressed in the final year of the move. Most of the drama, most of the percentage. And I think we're at that, we've crossed that line now. I think we're entering the acceleration phase.
Can you explain a bit more of the outperformance we've seen in silver and miners with respect to gold? I know the gold-silver ratio has declined a bit during this slight consolidation here. It's increased, but mainly down in the last month or so.
We measure silver versus gold a different way than other people do. What we do is we divide the price of silver into gold. And if you do that, silver right now is just below 1.2% of the price of gold. If you ever close a month, frankly, if you close a week, in our opinion, about 1.21%. So not far above where we've been laboring the last several weeks. You're going to break that spread out. Now, what I mean by breakout is this. If you go back to 2020 high, when silver vastly outperformed gold in that surge, there's been a relative performance staircasing downside action on that spread, where silver's been losing value relative to gold. But you can plot it. It's a beautiful trend line. It's like a 5-point rally trend line. You hit the line, you back off. And so we're now pushing to try to get through that line. You do the same thing with GDX, the miners ETF versus gold. You have the same sort of declining pattern since the surge in 2020 when miners beat gold. It's already breaking out with this month's action. So we think that that's going to be the final signal that tells us that, yes, we are in the acceleration phase. Because you go back and look in that late 2001 to 2011 bull market in gold and silver, it was in about 2010 that silver beat the pants off of gold. It just suddenly erupted and went to $50, from like 20. So it was not only acceleration in both metals to the upside, but at that point in time, in the final year especially, and this is true in 1979 to 80 as well, which was the tail end of that bull market, silver vastly beat gold. So while it might have bored you during much of the bull trend, up through 1979 or up through, let's say, 2008, where silver was sort of keeping pace with gold, but really wasn't beating it. It was in the last year that silver went electric. And we're at the threshold of that right now. So anyway, it's going to be an exciting year and probably a lot less than a year to gain most of what I see coming.
And are there any price levels that you're looking at right now in general for silver to finally make that breakout?
It's achieved its momentum breakouts, measuring its price versus certain long-term averages, like a 36-month average, which is like a 3-year average. It's not the crossing of that average that was so important, but when you plot an oscillator, where you plot the monthly action of silver in its relationship to, let's say, a 3-year average or a 36-month average, you get a different pattern on the chart than you do when you look at the price chart of silver. That broke out just above $25. And we're where? $27.30 or so right now. So we're well above the momentum breakout of silver, the level that says you're re-engaging silver. You're re-engaging to the upside. The 3 years of boredom is over. Okay. The only lagged metric we have now is what we were just talking about, the spread relationship between silver and gold. Just needs a decimal or so more, and that spread will join and say, yep, silver's going to beat gold. And that's basically our final signal. We think there's other things going on in other markets that are influencing this. And, the bond market, stock market, U.S. stock market in particular, we think it's likely topped out of this recent teasing new high that it made due to 5 or 6 stocks primarily. We all know that story. We think that we got a sell signal the first trading day of April that said, okay, that rally is over. We're rejoining the long-term damage that had been done in early 2022 at prices not far below where we are right now, in fact. So I think that teasing rally to a new marginal high in a few select parts of the stock market's over. Now the process is that way. That will no doubt influence data points, which will influence the Fed. And believe me, they're probably eager to start cutting. They're just looking for an excuse. Why? I'm not going to allege political bias on their part, but I've heard from various sources on news programs and so forth that the Fed governors definitely don't want a Trump victory. So they don't want to do anything that would be harmful to Biden. And if the economy, if the stock market needs some saving, because that's one of the few things that the current administration could point to and say, look, the stock market's doing good. If all of a sudden that's not the case in the months prior to the election, which we suspect technically will not be the case, then that's going to hurt them. And Trump has already said he's going to fire Powell. So now, again, let's get off that subject. The Fed just needs some data points. Now, we saw one last week, GDP, vastly lower than expected. All you need is like a change in the employment numbers. Now, over the last 3 or 4 months, if you objectively looked at the data that was issued about employment, unemployment, job creation, et cetera, and looked at what components of the job market saw growth in employment. There were government, home health care, hospitality. These were the sectors that grew in job gain. Things like core industrial sectors, core sectors of the economy. Also, government was a big factor in the growth. And this has been true for like 3 months, such that UBS I think it was the head of trading at UBS said a week or two ago, Powell, aren't you reading the data points? Can't you see what's going on here? Why can't you identify that the unemployment numbers really haven't been what they superficially look like? They really aren't good. And Powell's come in and said, oh, it's looking good. Well, what they need, the Fed needs an excuse. And if they can get one like this week, if all of a sudden the job data changes a bit, then that'll be a second piece of data. They got a real problem, though, because they have 2 mandates. One is to fight, quote, inflation as they narrowly define it, which is like especially commodity price inflation. Our assessment is the Bloomberg Commodity Index is about to be reborn again. That surge in 2020 to 2022 ended. We corrected. We're about to go again on the upside. So that's going to continue to put pressure on them to maintain high rates. If only they could get some unemployment data and some weakened data points like GDP, then they can go to their other mandate, which is the employment issue. So they're really split. They've got a problem. I wish them well.
I mean, many people have talked about the Fed being trapped for quite a while here, and this might be finally coming to a head here because, as you mentioned, if there are employment issues, but then you're also trying to fight inflation, it doesn't seem like there's really anything they can do and win in this case.
Yeah, they'll have to cut, and they will cut. And the ECB has already hinted that they're through and so forth and so on. So it's not just what the Fed does; it's what the other developed economy central banks do. And you can bet that if certain asset categories that they don't want to see go down, such as the stock market, go down, they'll never admit this, but that is a factor for them. They will definitely cut. They also have a bigger problem this time. We're used to seeing in these bubble breaks, the crisis come to private banks. And we had a wave of selling a year ago, when the banks crashed for like 30% in a week or two. And they've never gone back to their high, by the way, the bank sector. That concerned them, but they dismissed it. Okay. But commercial real estate's a real problem right now. And it's not getting better. And even when you look at the charts of it, like RWR, ETF, and so forth, they're sick. They don't even look like the stock market. And so it's the government bond market that's really behaving badly. Not so much private debt, the T-bonds, the 30-year bonds. They have not stopped. They've not paused like the Fed has done on the short end of the market. T-bonds keep choking with higher rates. And that's the end of the market that hurts debtors the most. The long-term adjustable rate mortgage, et cetera, that's hurting corporations and individuals. And so it's their bond market that is the real threat this time around. And they don't control that end of the market very well. So they've got a real crisis at hand. And I think they know it, but they can't admit it.
Now, when it comes to also real estate, I know that you're expecting a downturn from here as well. When do you expect that to start and why? Again, pop up a chart of RWR when you get a chance. Your people watching this and put it on your screen. Like put up a monthly bar chart of RWR. Go back 5 or 6 years, and you'll see it had a big move with the stock market. And then it's come down real hard since 2022, just like the S&P did. But the S&P turned back up and nipped out its high by about single-digit percentages. Now it's starting to give that back. But look at RWR, and it's laid in the bottom half of the price range since the drop in 2022. And right now it's nudging toward what's been a multiple bottom, even on the price charts, that looks like it's very anemic. How come it can't get going? Now, Janet Yellen just said a week or two ago, she's not too concerned about commercial real estate. It's, quote, manageable. Well, we quoted her on the weekend report because Bernanke said something almost the same in May of 2007. He says, no, the mortgage market's, it's manageable. Okay. So we have assurance from above that, no, there's no problem. When you look at the chart, there's a problem. And if that commercial real estate cracks just a little bit more, single-digit percentages, it's going to blow out the bottom of that range, in which case, while the stock market is coming back off of its teasing highs, commercial real estate's about to sink through multi-year lows. And believe me, that has real-world consequences, the kind that will definitely cause the Fed and the ECB and so forth to flip policy back to what they do the best, print. Gold knows that. And mentioning, staying on real estate here, also, I know that I heard an interesting argument about, so this was, I believe, last August, Warren Buffett was investing in home builders. Now, it sounds like late February here was announced that he has sold them now, and you just analyzed a chart of home builders index there. How does that maybe differ from real estate, if at all?
Well, it does. It shot to a new high along with the stock market. But it's limited to 4, 5, 6 big names that we all know, home builders. It's looking like a blow-off that's collapsing. Meaning while the commercial real estate market dropped and went sort of dead, anemic, sick, the home builders shot up to a spike new high above the 2022 high, but they're collapsing back down as if that new high was a fake out, which I think it was, technically speaking. And so it looks different than the commercial real estate, but the commercial real estate is quite potent. It's quite heavy. It's quite important to the economy. And we all know stories, like there's some skyscraper in St. Louis used to be the biggest skyscraper in the U.S. or whatever. And, you could buy it for a couple of $1 million, et cetera. So anyway, it's not good looking. And even the home builders now, which had that, what we call a blow off, which is to say an exhaustion spike, we think they're headed down too. So that end of the market, the real estate market, but especially commercial real estate, is a very dark cloud.
And then when it comes to precious metals, coming full circle here, it seems like if these other markets are not going to do well, if they're going to crash, or even if they're just going to see, a downturn here, that should be good for alternative asset classes.
Yeah, and it used to be T-bonds were an alternative to the stock market. The old 60-40 rule, 60% stocks, 40% bonds, you balanced, quote unquote. Well, 2022 proved that was wrong. T-bonds went down more at the stock market. And right now, T-bonds are back in sync with the stock market, meaning they're going down, yields going up. At the same time, stock market's starting to turn down. And it leaves, when you look across the spectrum, if you're a large asset manager, and I mean, not even a gold bug, okay, you're managing billions. And you've been primarily loaded up in the stock market because you had to be, even if you're skeptical. Why? Because it's going up, and if you're not in it, you're not making money, and your peers are beating you. So you've got to compete with your peers. But there's a lot of skeptics out there, and some of them have already made Stanley Druckenmiller in mid-February is an example, made headlines when he dumped 2 or 3 big name tech stocks, and they've since gone down. But he bought Newmont and Barrick Gold, 2 of the big blue chips. Well, I mean, I look back at the chart when that was announced. It was like February 20th. You looked at Newmont Mining back then; it was trading about $32. Where's it now? 42. 10 weeks, it's gained 35%. He was right on his assumptions, and there's more guys like him that are jumping in there. I'm reading about. So as the stock market starts to wobble, it doesn't even have to crash when anyone look at it, just wobble enough to create doubt on the part of risk managers. We're saying, I just too heavily weighted in this less reward, higher risk sector. I need to move 5% over somewhere else. And you look around, what else is performing well? Suddenly the gold miners are performing very well, Thunderbolt type upsides. And they're looking at gold and they're saying, geez, I better move into the monetary metal sector, or the miners related there too. And anybody who looks at long-term charts of the miners, compare them to the S&P or compare them even to the price of gold, they're vastly undervalued. I mean, to the point of insanity. And that's why, Newmont went up 35% in 10 weeks. It wasn't just because Druckenmiller bought it, because frankly, after he bought it, went up a couple bucks. But obviously somebody else bought it. And I think that sector is probably going to be the most outperforming sector among stocks for the next year. Vastly so.
Do you expect this bull run to be kind of done within about 12 months then, or how long do you think this final stage could take?
Yeah, I think it's going to be different this time, though. I think the outcome, instead of a top and then a bear market in gold, I think the world is facing a monetary crisis and an economic crisis, a political crisis, all things coming together. It's not just markets, okay? Don't think about markets. Think about political instability, turmoil, non-copacetic outcomes to elections, outcomes that are totally surprising. Like Argentina, you had 2 parties have been in power for decades. Socialism prevailed. And all of a sudden, this young economist, intellectual, Javier Milei, who's an anarcho-capitalist, comes in there and says, that's it. And the kids voted for him. He beat both parties, knocked them asunder. And he's starting to chop government up and sell it off. And suddenly the price of rentals down there, which had been off the page for families that couldn't afford it, is collapsing 20%, which means it's gotten better for the poor, so to speak. But, out of the blue, that came. Nobody expected that. And in the U.S., the outcome, I don't care how you pick which side you're on. No matter who wins this election, it will be not copacetic. I've mentioned before in interviews, the University of Virginia Department of Politics did a poll back October, and they polled Biden voters and Trump voters. And the opinions were fairly weighted on both sides that secession wouldn't be a bad idea if the other side wins. A large percentage on both sides said if the other side wins, violence might be justified. I mean, this is not going to be copacetic, no matter who wins. So, and I don't think that's built into the price action of the market yet. I don't think the market understands the ripping of the tablecloth off this time around. It's not going to be a normal election and normal outcome.
Should be, I guess, interesting to watch, definitely, as we head towards the election here. It'll be great to have you back on to continue to track this with you. Any last thoughts before we let you go? And where can our viewers find you online? OliverMSA.com. Explain our methodology there. Scroll down through our values, what we offer you. And we've inserted a film at the bottom of that we did about 8 years ago. It's a comedic little film, about 7 minutes long. It explains our methodology in a humorous way that makes it less dry to hear the explanation of the methodology. And by the way, I've lost weight since I did that. Anyway, which is good. Anyway,
Yeah, and request a sample. We're happy to send you sample reports, but take care of your families is the main thing to do this year. Don't worry about the world. And right now, the best way to take care of your family is to get out of certain assets and get into others, and and relax a bit because it's not going to be a relaxing year if you're in the wrong place.
Definitely. Well, Michael, once again, thank you so much for your time, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.